Today's episode is inspired by a client question that came in today. And that question is, should I be putting all my money into one account for faster compounding, or is it better to spread it across different accounts? Believe it or not, this is a question that seems very simple, but it's really complicated if we break down this question using real numbers, tax implications, estate planning factors, and investment options. So you have to really understand all of that to make the best choice for your financial future. So let's take a look at this. Let's take a look at the compounding growth aspect. So let's talk about why this is even a debate. Some people believe that having all your money in one account will allow it to compound faster because the balance is larger. And technically it makes sense. Yes, compound interest does work best when you're reinvesting earnings and minimizing fees. So for example, if you have scenario A, let's say you have $1 million in one account compounding at 8% per year, but then you have scenario B at $1 million spread across 4 different accounts, each compounding at 8%. Mathematically, the compounding is going to be exactly the same, but the real difference comes with factors like taxes, access to funds, and diversification. So let's talk more about these different factors, like the role of tax location. So one major factor that could impact your growth is how your investments are taxed. So if all of your money is in one taxable brokerage account, you're dealing with capital gains tax every time you sell something. But if you spread it across tax deferred accounts like a 401k or an IRA and tax-free accounts like a Roth IRA, you could create a more tax efficient growth strategy. So an example could be, let's say you have $1 million in a taxable brokerage account. Well, that's going to be subject to long-term capital gains at roughly 15 to 20% upon withdrawal potentially, versus if you have $1 million split across multiple different accounts, like 500K in a taxable brokerage account and then 250,000 in a Roth IRA, which keep in mind that that's tax-free withdrawals in retirement. And then 250K, for example, in a traditional IRA. You're getting tax-deferred growth there, and eventually you'll get taxed when you make withdrawals. But the key takeaway here is spreading money across different tax locations can help you lower your tax bill in the long run and increase your after-tax returns over time. Now, let's jump into estate planning considerations. So if you have everything in one account, what happens when you pass away? Are your beneficiaries properly set up? Is the money protected from probate? Well, let's look at an example. If you have one single large brokerage account, your heirs may have to go through probate unless it's set up with a transfer on death designation or it's owned by a trust. So if you have multiple accounts with beneficiary designations like IRAs, Roths, and life insurance, those are going to pass directly to heirs, potentially reducing estate taxes and any legal hassle. So the key takeaway here is diversifying your accounts can help with estate planning, make it easier for your heirs to inherit assets without unnecessary legal delays. Now, investment options and liquidity is a factor as well. So having different accounts also comes with different investment choices. A 401k, for example, has limited funds, but a brokerage account gives you access to every individual stock, every ETF, mutual fund, and more. And let's not forget about liquidity too. So you can easily access your money in a brokerage account versus a 401k only or something like that. Let's look at an example of this. So if you have one brokerage account with $1 million, well, more investment choices, but no tax benefits. But then if you look at multiple accounts, so let's say you have a 401k, which is pre-tax, you can't access that until you're 59 and a half without penalties. You can have a brokerage account, AKA taxable account, that's fully liquid. And you have your Roth IRAs. Roth IRAs are tax-free withdrawals after 59 and a half if you meet certain rules that the IRS has for you. But the key takeaway is if you need liquidity for a short-term goal, like buying a home, keeping everything in your retirement account is not ideal, especially if it's a 401k, because instead, spreading funds across accounts, it gives you flexibility to manage different financial needs. And so I'm always a big fan of making sure that you have a different portfolio and have the right asset location for each goal. So for example, a short-term goal is going to look much different than a long-term goal, right? And so the final takeaway is looking at all the pros and cons of having all your money in one account or spreading it out across multiple accounts. So the real answer is going to depend on your specific situation, your goals, but let's just run through some quick pros. So the pros of one account: it's easier to track, it's potentially lower fees, and it's going to simplify your investment management. The cons of one account is it could limit tax efficiency, it might not be ideal for estate planning, and it's less flexibility for withdrawals. Pros of multiple accounts: you have tax efficiency, you have typically more investment choices, and it's easier to do an estate transfer. Now, the cons of multiple accounts is it's more to manage and potentially higher complexity and potentially even more expensive depending on who's managing it or where the funds are at. The best approach, in my opinion, is to have a strategy that aligns with your short-term, mid-term, long-term goals. But you also, here's the kicker, you also have to consider taxes, estate planning, and your overall liquidity needs. So that's how you make your money work for you. And that's how you can determine what can make sense for you and your situation. So if this helped you, go ahead and hit that like button, subscribe for more retirement and investment insights, and let me know in the comments, do you prefer having all your money in one account or do you prefer to spread it out? So thanks so much. I'll see you next time. Cheers.